Hello, this is Lee Gantt with GrowthPoint Investments. Thanks for taking the time to view this presentation. We're going to talk today about our GEMS Diversified Trading Program, which is a premium selling program that's diversified in grains, energies, and metals. First, a disclaimer: futures trading is risky and it's not suitable for all investors. Just a little bit about me. Our CTA, GrowthPoint Investments, is located in Johns Creek, Georgia, which is a suburb of Atlanta. I started trading options in 2004 and 2005 with my IRA, and began trading client assets since 2006 after becoming registered with the National Futures Association. There are two of us in the company, myself, Lee Gantt, and Craig Culpepper, who joined the organization in 2010. Craig is the CTA that trades the GEMS program. About my background, I have a master's degree in electrical engineering from Georgia Tech. I've been involved in several startups over the years. I have a computer consulting company that's about 14 years old, and I became interested in options trading in 2003 through a group here that meets in Atlanta called the Atlanta Options Forum Group. I started reading, attending free seminars, webinars, anything I could get my hands on, and at some point I started focusing in on one approach, which was premium selling. I traded my own money, as I said, in 2004 and 2005, and I registered as a CTA at the end of 2005 so I could start managing client assets in 2006. Craig has a banking and finance degree from the University of Mississippi. He was the associated person at Leadership Financial Corp and American Derivatives, and after that he was employed at RJO as a floor broker in the grain pits from 2004 to 2006. Craig formed Culpepper Investment Group in 2007, and he became an associated person at GrowthPoint Investments in May of 2010 to trade the GEMS program. The other program that we have is called the Index Program. It used to be called the Iron Condor Program. The Index Program is premium selling strictly on the S&P 500, so it's not diversified. It is a ratio spread type strategy. It's a 1-4-3 put spread strategy, not a standard vertical spread. So it's a little bit different than what I'm going to describe here that we do with GEMS. GEMS are vertical credit spreads, like I mentioned before. They could be on the call side or the put side, depending on the market fundamentals and technicals. We trade in the grains, energies, metals, and softs, and I'll show you some examples of that. Our trades are typically 120 to 180 days until expiration, but we're typically getting out of them before they expire. It's very unusual for us to have a trade that we take all the way into expiration. And I'll define the risk management strategy here. And it is based primarily on market fundamentals. An example of how we might set a trade here in a well-defined uptrend, like you see here on the screen. We might go, 25, even as much as 50% below the market with very small deltas or very low probabilities, and we would sell put spread. We might typically try to bring in $500 before commissions in this put spread. Conversely, if we have a well-defined downtrend, we might be selling call spreads above the market on, say, like in this example here, you see a little bit of a pullback. We might sell calls during that pullback. In this case, we're trying to be 75 or even as much as 100% out of the money, again with very small deltas, 7 to 20% range. As far as risk management, what we're typically doing is, as I mentioned, bringing in around $500 on the average, and then we're exiting the trade when the premium doubles or triples. Typically, in most trades that we're doing right now, in a market that's very volatile, is when the premium doubles, we're exiting the trade. This gives us a 1-to-1 or 1-to-2 risk reward. And it also, so basically another way to look at it is if you earn $500 on the trade, or you lose $1,000 on the trade. And of course there is the issue of slippage. Slippage basically means you're not able to get the exit that you wanted or that you asked for. So it's not always possible to be able to exit the trade exactly when we would like. So let's look at how we're diversified in complex. I said that we did grains, energies, metals, and softs. So grains might be soybeans, wheat, corn. Energy, we might be selling oil, nat gas. Metals, gold, silver, copper. And then in the softs, we've done some cocoa, some sugar and some coffee trades, for instance. Typically, we're bringing in about 2%, or we're out of a $25,000 allotment. We might bring in, say, 2% in each one of those areas in a given month. That doesn't mean that we always bring in that much premium in each one of these three verticals. Sometimes we might double up on one particular vertical, but the idea is that we're diversified into all these different areas. We're also diversified in time. You see here, if you at the beginning, we've got a trade that's 120 to say 180 days out from expiration. So we've got grains, energies, and metals. 1 month later, that same account for that same $25,000 has the existing trade that now only has 90 to 120 days left, and we're setting another 120 to 180 day trade. Again, typically in grains, energies, and metals in three different market areas. Then again, finally, after 3 days, we would have what we would refer to as a full pipe. So we've got one spread, one set of trades that's only going to last for another 30 or 60 days, and then another group still got 90 and 20 left, and we're setting a new set of trades for 120 to 180. So this is showing how we're diversified in time. So in this particular example, we've got a 30, 60, 90 to a 120, and 120 to 180, all broken up into into a bunch of different trades here. So one of the things that we consider are seasonal considerations. We're always paying attention, of course, to things like the crop reports, and certain commodities tend to trade certain ways in different seasons, so we're always very aware of what those things are. Supply and demand considerations, obviously those things can move markets quite a bit, so we can trade around those things. And then of course some technical analysis, looking at support and resistance levels and different market conditions, price movement and so forth. We're not doing anything terribly complicated, but we are paying attention to that. So we talked about the fact that we've got diversification in time. One of the things that's going to mean is that you could have some losses in the first 1 to 3 months as the trades get stacked on in the account. That's because these trades can be volatile. They can get close to a double but not quite. They can move back again closer to zero, which is what you want them to be after you set them, and they can move back and forth. So they're going to fluctuate a little bit. Most of the premium decay occurs in the last 30 to 60 days. So there can be quite a bit of variations. If we go to wind down an account, if someone needs to pull money out of an account and we have to trade, remove some trades, that can take a little bit of time. We can do it obviously as quickly as you want, but to do it, in an orderly manner might take a little bit of time. 90% profit buyback before expiration. What this basically means is we're looking to buy the spread back well before we receive the whole 100% profit. That's because that last 10% can really take a long time, and it's really not worth waiting on. We make very low use of margin. I'm being very conservative when I say as much as 50%. It's typically more like 20-25% margin based on span. We do accept notional funding, maximum of 25%. Of course, it's very important to understand that if an account is leveraged up, that the profits can be higher, but the losses can be higher too. One thing that customers can do is cross-margin this to our other program, our index program, where we use a lot more margin. We require more margin in the index program, but we would typically, say on a $100,000 account, always have, say, $25,000 sitting around. So that could be leveraged and used to cross-margin to this program. This program does have a $25K minimum. The other point is that because this program is trading grains, energies, and metals, it is not very well correlated to the index program, and that's by design. We want customers to have an alternative to the index program, which is very tightly tied to the financials. There's a very quantified risk management. It's very simple. We're usually not, doing rolling strategies and so forth. Basically, when it triples or when it doubles, we're buying it back and we're moving on. I like to tell folks that it's basically 80% discretionary and 20% systematic. The systematic part really has more to do with the cash management and the risk management. The discretionary is the timing of getting into the trades and then when to buy them back. So that's it. If you have any questions, please get in touch with Paul Rieger at MF Global. Paul can get you copies of our disclosure documents, our track record, and answer any questions about the program. Also, if you're interested in having a one-on-one session to discuss the strategy and ask any questions, we're happy to do that at any time, and Paul can arrange that for you. So again, thank you very much for your time for watching this presentation.